Hey everybody, welcome back. Now in this quick video today, I wanted to talk about 6 strategies on when to take profits in your trades, whether that's crypto, stocks, or forex. Please drop a like if you find this useful, and without further ado, let's dive on in. Alright, now before diving into our 6 different strategies, I just wanted to stress that in all cases, your trade fundamentals should look good. So that means your trade has a good combination of risk to reward and your win-loss ratio looks good. Now, what do I mean by these ratios? So in a typical trade, for example, this long trade on Bitcoin here, you have an entry price, you have a take profit price above that, and a stop loss below. Now we can draw this tool here on TradingView by going to the predictions and measurements button here and then clicking on long or short position depending on which trade you're going for. Now on some exchanges, for example FTX here, I can set what's called a bracket order, which essentially creates 3 orders in one go. I've got my entry, my take profit, and my stop loss. My risk to reward ratio is 1:3, more on that shortly. After placing my order, I can then drag any of these 3 points up or down if I change my mind about any of these levels. Okay, so why is my risk to reward ratio 1:3? Well, here my upside is 3 times my downside. In other words, we're risking $1 to make $3. That's great, right? Well, maybe not. You also need to look at the market conditions and assess the chances of your trade going your way and actually hitting this take profit here, as opposed to going the other way and hitting your stop loss first. Right, so that's what the win-loss ratio is all about. You see, a 1:3 risk-reward ratio doesn't really mean much if you're way more likely to break down than to break up. Right, so I'll make a dedicated video on risk to reward and win-loss ratios. There is a lot to talk about. For example, traders, then look, we've all done this to try and limit our risk, right? We try to cap our losses by tightening our stop loss. Now, although this effectively increases your reward to risk ratio, it does come at the cost of reducing your win-loss ratio because you've now made it easier to trip your now tighter stop loss. So the point I'm trying to make here is risk to reward and win to loss ratios are mathematically connected, right? If you change one, you're going to affect the other. So generally, the better thing to do is to give your trades room to breathe, right? Now, this immediately means that you should never trade too much of your account in one go because you might liquidate your entire account in one fell swoop, right? With trading, you're essentially playing statistics to come out on top in the long run, right? But in the short run, hey, you might lose 5 trades in a row if you're having a bad day. Now, this is in contrast to strategic investing, right? Where you basically buy, for instance, Bitcoin in the middle of the bear market in accordance with data science models, and then you sell it near the top during the bull run, so that essentially 100% of your trades end up in profit. With trading, you win some, you lose some, but hey, the aim is to win more often than not, taking trades that ideally have more reward than risk. By the way, if you wanted to sign up to a major exchange like FTX or Binance, these are the 2 exchanges that I like to use. Feel free to sign up using my links down below where you can get a permanent discount off your trading fees. Alright, so moving on to our strategies. Well, the first one is you take profit according to some fixed risk to reward ratio. So for instance, let's say 2:1. Right, so you'd enter a trade, you then set your stop loss in accordance to whichever pattern that you're trading along with the current volatility, and then you're basically going to make a consistent commitment to exit at a price when the upside is twice your downside. Now, the elegance of this strategy lies in its simplicity, right? Because successful trading is all about executing good strategies over and over and over and over and over again. And a robotic rule like this enforces consistency and helps remove pesky emotions that could get in the way of your trades because, well, you're essentially forced to take profits at a certain level every time. Now, the next strategy is to take profits at key resistance levels, since as the name resistance suggests, there's a decent probability of having the price rejected at these levels. So you want to consider both the short term alongside the long-term resistance, zooming out to perhaps the entire year. So for Bitcoin, in the short term, we can see 45K to be a level of resistance, right? The BTC price has basically bounced off this level twice in the past month. And on the longer time frames, 42K and 58K, roughly speaking, have been strong regions of resistance and support. So looking at the important 42K level, initially we rejected and then had a massive breakthrough a month later, and then a successful retest that flipped 42K into support and then lift off. And then throughout the year, a 42K continue to serve as important regions of resistance and support. Now the next strategy is to take profits at previous swing highs if you're longing, and swing lows if you're shorting. So for instance, looking at Bitcoin back on the shorter time frame, we've got a swing low, swing high, swing low, swing high, and so forth. So it's pretty clear that this level here, roughly 45.5K, is a pretty good place to take profits if you're longing Bitcoin and trading these swings here. Alright, the next strategy relates to well-established chart patterns, which is the bread and butter for many traders. Now we can break these sorts of trades down into two different cases. Firstly, trading the swings in a channel or a wedge or a triangle, where basically the price is essentially oscillating between a higher trend line and a lower trend line. So here you can enter and take profits as the prices bounce up and down. So for instance, if you enter here, take profits, and then enter here, take profits, enter, take profits, and so forth. And then secondly, trading the breakout of one of these patterns. And the great thing about these well-established patterns is they tend to have these easy to follow rules where you can set your take profit targets. Okay, so let's illustrate with Ethereum now. So we can see that the ETH prices have been bouncing inside of this triangle. Now let's say you entered a long position here right after the US Fed FOMC meeting where there weren't any surprises. So then your trade setup would look something like this. You've got a take profit right below the upper trend line, and you've got a stop loss right below the lower trend line for a risk reward ratio of roughly 1-to-1. Right? Upside is roughly equal to downside. So in other words, you're going to risk $1 to make $1. Now, that doesn't sound very good, right? Well, the appeal of this trade, it's not really the risk reward ratio, but the higher win-loss ratio. Right? No new news is good news when it comes to the FOMC meetings these days. In other words, no nasty surprises with interest rates. Everything has already been priced into the markets. So therefore, after this meeting, there was a high probability that there was going to be a bit of an upward move. So again, when trading, you need to take into account both your risk and reward ratio along with your win-loss ratio. A mediocre risk to reward ratio, that's okay if your chances of winning the trade is pretty good, right? Meanwhile, a crappy win-loss ratio might be justified if the potential profit is way bigger than the potential loss. Alright, so moving on, after some time we saw that the Ethereum prices broke out of our triangle here, and we can trade this, right? It's this pattern right here. Now, hypothetically, let's say you entered into a trade right here. That's your entry. You set your stop loss a little bit back inside the triangle, just in case the breakout here ends up being a fake out. The question is, what is your take profit target? Right? Now, for a triangle, traditionally it's been the distance between the highest point and the lowest points at the beginning of the triangle. Basically, it's this distance right here, and that's going to take our take profit target up to around $3,900 for ETH for a risk reward ratio of 1-to-5, right? 1-5. You're going to risk $1 to make $5. Now, unfortunately, in trading, nothing is black and white. It's all a game of probability and statistics. So are we likely to go all the way up to $3,900 for this trade? If you're feeling really bullish, hey, perhaps. If you're not, because of spiraling commodity prices, geopolitical fears, inflation fears, fears of recession, what have you, Ethereum might also see some resistance because it's currently running into its bull market support band, acting as resistance. So look, one thing you can do is temper your expectations and adjust the risk to reward ratio, right? So we can lower our take profit mark, right? Maybe say down to here. And in exchange, we're going to gain a better win-loss ratio, right? Because now your trade, even though you're not going to get as much reward, you're more likely to actually reach your take profit target, right? And that's important too. Okay, the next strategy are Fibonacci extensions. Now, there are two types of Fibonacci tools. There's the Fibonacci retracement tool, which helps you enter a trade by suggesting how far prices might pull back after an impulse move. And then you have Fibonacci extensions, right? These levels here, which help you decide where you could take profits. Now, to make a Fib extension on TradingView, what you want to do is go to the Gann and Fib tools button and then click on trend-based Fib extension. Now, just a quick note, for Fib retracements, you need 2 points. For Fib extensions, you need 3. Now, on this chart here, we're going to use this rally here to make our Fib extension. So this rally, this is called an impulse. The first point is going to be at the beginning of the impulse. The second point is going to be at the end of the impulse. And then we drag back and click on the end of the retracement, which is here. Now that we've got our fib extension levels, we can then use them to decide where to take profits potentially. Now the levels I generally suggest are 100%, 138%, 161, and 200%. I'm happy to dive into these numbers in another video if you guys are interested in where they come from. Now, just note out of interest, the save trade here that we have earlier matches up to the 100% level, while our more ambitious 1 to 5 risk to reward ratio trade matches up roughly to the 200% level. Now, I do want to quickly mention there are a number of caveats with fib extensions. So you want to use them in combination with other tools such as previous resistance levels, especially if the trend is strong. So otherwise you might end up closing your trade too early and miss out on the majority of the move. Now, what do I mean by this? Well, there was a period of a few months in the middle of the year where basically Bitcoin, and by extension the entire crypto market, essentially traded sideways, established really strong support around 28k to 30k, which meant that when we eventually saw a breakout, it was very likely we're going to see a very strong upwards move. And if you entered into a long position roughly here, then you would have definitely wanted to give your trade quite a bit of breathing room to ride this rally up. If instead you took profits at the 100% or even 200% fib extension levels, then chances are you would have missed out on a lot of this rally up. So in summary, you want to adapt your fib extensions to the market conditions. They're certainly not black or white rules. Finally, strategy number 6 is to enter and take profits around major news announcements or project updates, right? So as they say, buy the rumor, sell the news, or in the case of blockchain updates, buy the testnet and sell the mainnet. Now, a great example of this is Cardano's Alonzo hard fork upgrade in 2021 that introduced smart contracts. So traders bought ADA up in droves at the announcement of the testnet deployment, with ADA exploding all the way up to $3.20 just before the mainnet launch a month later. And then since that time, we've seen a full retracement of that impulse move and actually more. On the other hand, I should mention that prices don't always pull back in situations like this, right? The Ethereum prices actually rallied after the London hard fork. Now, this is where some research into the fundamentals of the project you're trading does matter. So Cardano launched smart contracts, pumping its token to a whopping $80 billion market cap when it reached $3.20, but unfortunately its DeFi backend wasn't anywhere near the level needed to sustain the buy side pressure for ADA, so prices ultimately dumped. Ethereum's London hard fork overhauled Ethereum's monetary policy and gave investors a compelling reason to buy even more Ethereum. But generally speaking, in the crypto space, I would say taking some profits off the table right before major updates go live. Look, it's not a bad way to go, right? Not financial advice, of course. Alright everyone, let's leave it there. Please drop a like if you found this video useful. It's the only way YouTube will notice me. Let me know in the comments down below if you have any questions or comments. I'd love to hear from you. If you want to sign up to FTX or Binance, feel free to use my links down in the descriptions below where you can get a permanent fee discount. Have a great day or evening wherever you are, and see you in the next one.